For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, thank you very large. This is Managing Your Financial Future, podcast time. Once again, Johnny Dean, your podcast host. And once again, I'm graced by the presence of Professor Rick Plum, certified financial planner, professional accredited wealth management advisor. Happy to have everybody here yet again. So what is that phrase? What was the phrase? I just used it. Rick, when you assume something... What is that? You make
something of you and me.
You make an ass out of you and me. Yes. I first heard that like when I was a kid, and I thought, well, that's kind of funny. But we're going to be talking about assuming today. Actually, I think we'll have time to get through three retirement assumptions that ultimately I think can cost you. And we like to point this stuff out because all too often, things go unnoticed by people. It can be very hard. When you're working, Rick, I think things are fairly straightforward. Okay, you get a paycheck. That's your bucket one. There, your taxes come out. Maybe you throw some money into your 401k. You file your tax return and all that stuff. But there's kind of a rhythm to it, and people are fairly used to that. But once you retire, and then the paycheck stops. Now you got to supply, in many cases, your own income, assuming you don't have enough on the guaranteed side, which for many people I think is a scary thought. So today I want to talk along those lines about a few retirement assumptions that actually I think they sound reasonable, and they are, and they're things that smart people say all the time, but they may not be good for you if you don't know exactly what you're doing. Now, what is John talking about? Well, let's go through some of these assumptions. I'm going to be pointing out some areas, or you are, Rick, where it might be worth taking a closer look at some of these assumptions that people make, because it may not be working the way it used to. All right?
Well, you started off talking about people, they get used to their paycheck, they get used to their take-home pay, and they don't even realize in many cases what's going on before they see it. And now they retire and they have to actually account for, well, where am I going to pay the taxes from? And I pay what? What? Oh my gosh. It kind of scares them, because before that, they had the withholding, and assuming it wasn't way out of line, they got a little refund, or they paid a few bucks at the end of the year. And they're like, okay, that's all well and good. I have no idea what taxes I paid. But once you retire, you actually start seeing in many cases, seeing what taxes you're paying, and it's like, I didn't pay this when I was working. Yeah, you did. You just didn't pay attention.
It was true. Ask anybody, how much did you pay in taxes last year? I think the most common answer is, well, I didn't pay anything. I got a refund. And it's like, well, no, you just overpaid.
I would encourage everybody to find their tax return, find the line that says, this is your total taxes. Not the refund, not how much you have to pay at the end of the year. This is your total tax. And you'll be like, crap.
Rick Plum, this is your tax.
You're like, golly.
Yeah,
and that line includes the NIT if you're paying it, that investment income tax. It includes a lot of ancillary taxes, self-employment tax if you're self-employed. It's not just the ordinary income tax or the federal income tax.
Well, okay, so let's take that, since we're talking about taxes, let's talk about this first assumption. I'll put that first up. People, I think, assume they know what tax bracket they're in, because they might look at their tax rate and they'll say, okay, well, I'm in the 22% bracket or the 12% bracket, whatever it is. So if I'm in the 22% bracket, I'm paying 22% in taxes. Now, let's talk for a second, Rick, about marginal versus effective tax rates, and then I'm going to get into a little real life scenario, but let's talk about that.
Before we get into that, there's an issue between semantics and what is actually out there. So people that are really bright and they do everything themselves, and they look online, they look up the tax brackets, and they say, okay, the top for a married couple filing a joint tax return, the top of the 12% income tax bracket is it's around $102,000, give or take. So I can have $102,000 and stay in the 12% bracket. And they think, well, that's wonderful. But if I go over 102, I'm going to go up in brackets. Well, the problem is you're looking at the wrong wording. You're looking at something called taxable income, not gross income. You can have a lot more income than that and stay in the 12% bracket because you have these little things called deductions. Whether you have a itemized deductions or standard deduction, and then you've got the potential of the $6,000 senior deduction. So for a married couple, you can have a lot more money. You can have like $140,000, $150,000 of gross income and stay in the 12% bracket. Sort of.
Well, let's explain this then.
But yeah, so if you're looking at it, is the 12% bracket really the 12% bracket? And what happens, one of the misconceptions is that, okay, my bracket ends at $100,000 and after that I go into the 22% bracket. So if I make $102,000, that's not the exact number, but I'm over the 12% bracket, that means that all my income is at the 22% bracket.
Mm-hmm.
No, that is not what it means. It means the income over that threshold is at the 22% bracket, but the income under that threshold is still at the lower bracket. It's a progressive tax system, not a regressive one. The other one thing I hear from time to time, don't hear as much anymore, but well, that bonus that I'm going to get is going to cost me more in taxes than the bonus was because it's going to put me in another bracket and the increase in taxes is more than the bonus. And that assumes that regressive issue that doesn't actually occur. There may be reasons for why you feel that way due to withholding issues, but that's not the true tax. That's just a guess on what you owe in taxes. But yeah, actually understanding the tax code is not the easiest thing in the world, but we do have a progressive tax system. The first X amount of dollars does not get taxed because of the standard deduction or your itemized deductions. The next block is at a 10%. The next block is at a 12%, and so on up the line. When you move into another block, you don't go back to the very first dollar and say, well, what was a 10 is now a 22. That does not the way this works. You just start having more expensive blocks added to the less expensive blocks, and you get to pay the cumulative combined amount from each of the blocks.
That's one of the most misunderstood things about taxes. Maybe not as much with our listeners, I don't know, but maybe it is, because it makes sense. Gosh, I'm in a 22% bracket. I am paying 22 cents on every dollar. We've heard this so many times. Now there are a lot of things that can affect this.
And that's why average tax bracket, it's very important to know the average. But I read articles that say, you do conversions at the average bracket. That is a bunch of bull. You don't convert at the average bracket. You convert at the marginal meaning the top bracket. And so it's costing you that marginal number. So, and the problem, though, isn't necessarily even knowing, okay, I'm in the 12% bracket. But for a lot of retirees, the 12% isn't a 12% bracket because if I have additional income, this comes up with Roth conversions all the time. I look at my taxable income line. So I look down my tax return. I'm getting good. I'm starting to actually see the names. Okay, here's adjusted gross income, but I don't pay tax on my adjusted gross income. I get to take my deductions from there. Here we go. We take our deductions. Boom, boom, boom. Here's the line that says, this is my taxable income. This is the line where I can now look and see what tax bracket I'm in, because that's where we're looking at. So if I look at my taxable income and I see that it says, $65,000, and I look at the line online and I say the taxable income for a married couple with income between $24,800 and $100,800 is in the 12% income tax bracket. That's cool. That means I am in the 12% income tax bracket. So I am going to do a $20,000, a $30,000 Roth conversion and stay in the 12% tax bracket. And I do a $30,000 conversion and my taxes go up by $6,600. So, wait a minute, I'm in the 12% bracket. Is this the new math that they're teaching now? What is going on? This math doesn't add up. 1 + 1 = 3, but that's not true. So unfortunately, what happened is income that was previously not part of the taxable income area became part of the taxable income area by adding more income. So while I'm technically in the 12% bracket, because of the way the taxability of Social Security is created, I'm not paying a 12% on that last dollar. For every dollar that I'm showing for a little while, this happened today. We were doing some Roth conversion issues. For every dollar that I'm showing in the beginning, I'm paying a dollar or 12 cents on that dollar, but I'm also paying tax on 85 cents of Social Security that wasn't taxable before. So I'm actually paying 12% tax on $1.85 instead of $1. And it was weird because this individual, this couple, they are not taking their required minimum distributions yet. They're not quite that age yet. They're living comfortably. They have a decent-sized IRA. They're looking at it happening in the not-too-distant future. And they're saying, well, we're in the 12% tax bracket. Is there money we should convert? Is there room for us to convert? And we looked at it and said, if you convert $30,000, that $30,000 is going to subject $23,000 of your Social Security to taxes that wasn't taxable before. So that's kind of expensive. But once you get past that 30, you've got another 35,000 of room that's at a true 12% bracket. So the next 30 was more expensive than the following 35. And so we said, we should be looking at doing about 65,000 of conversions. They said, that sounds okay, but let's only do half of that. No, that's the worst thing you can do, because that is a true expense. It made zero sense with the progressive system because of this Social Security stuff. And only people that know how the Social Security tax works, only math nerds are going to geek out on this stuff. And they're
you're talking about math nerds like Rick Plum is what you're talking about.
Yeah, and my buddies.
yeah, you and your buddy. Well, so wait a minute now. So on this example, and I'm going to move on to the others in a sec, but in this example, they have a certain amount of income. It's going to be taxed at 12%. If they add another $30,000 that they want to convert to Roth, that will jump their tax bracket. Where they're going to be paying more taxes. Yet, if they add another 30,000, so 60 or 65,000 of conversion instead of 30, they're actually going to pay
their
less.
Average bracket comes down. Yes, they're going to pay less on the second 35 than they did on the first 30.
But ask anybody, how counterintuitive is that? How is it possible that I can add even more money and then my tax bracket goes down?
Well, right now, they're getting about $50,000 a year combined in Social Security. And right now they're paying tax on about 20 of that Social Security. If they start adding more income, more Social Security becomes taxable until they hit a maximum of 85% of their Social Security. Once they hit the 85%, then no more of the Social Security becomes taxable. Yes, that new dollar of income will be taxable, but no more of the Social Security. So the first, like I said, first 30,000 is all creating taxable Social Security as well. So you're paying 12% on $1.85 for every dollar you convert. Once you max out the taxability of the Social Security, though, now you're back into just a flat bracket because now $1 is taxed at the 12% bracket. And so the first $30,000 was costing 22% per dollar, and the second 35 was only costing 12 cents.
Okay, so the point of this is that if
you're doing.
If you make an assumption that I know exactly what tax bracket I'm in, which goes back to these assumptions we're talking about, there's a good chance that you don't. And I don't mean that as a criticism. I just mean it as these tax brackets, especially when you add Social Security tax or whatever, it can become incredibly complicated.
Well, you lose phase outs. Once you get over $150,000 of adjusted gross income, that's before all the deductions. You start, for a married couple, you start losing your $6,000, additional deduction. If you, one of the people I was talking, we were doing some planning on today, they were talking about the ability to take capital gains in a lower bracket. But by taking the capital gain, they had a big offset because of health issues, and so the more gain we show, even though it's a lowered bracket, it's still part of the adjusted gross income, which takes away some of their deductions.
Oh,
So it's
okay. Oh man,
there's all these moving targets.
Yeah, it gets to be too much. I don't expect everybody to follow everything that you just said, Rick.
But you just
like
need to have somebody who does know how to follow it.
Yes, and this can get incredibly complicated. So that's why when I talk about assumptions, you might say, well, I know exactly what tax bracket I'm in. You may not, especially when you add in things like Social Security and all this other stuff. So just be aware of that. All right, so that is the first assumption. Let's see if we can make the others maybe a little bit less math oriented or complicated. I think did I say there was going to be no math? Rick,
we need that drop. That was Chevy Chase, right?
Yeah, that was. I was
Weekend
told there was
update.
going to be no math. Anyway, okay. So the second assumption people make is that, well, when I take my income in retirement, I'll just take it from whatever. I've got IRAs. I got the brokerage accounts. Maybe I have some cash, personal accounts. I don't care where I take it from.
Cash flow is cash flow. It doesn't matter, right?
Well, as it turns out, cash flow is not necessarily cash flow, and it does matter. Rick, just talk briefly, if you will, about why it matters which accounts you pull from.
Well, actually, I did an hour-long training course on just this subject this morning.
Wow.
And we were talking about blending or not blending income streams and where it might make sense for one client to do some what we call blending. Blending means taking my cash flow from different types of accounts. There's three basic types of accounts. There is a traditional IRA where nothing is taxable until I take money out, and then everything I take out of it is 100% taxable as ordinary income. There's Roth IRAs, assuming I'm 59 and a half and have had it for 5 years. There's no taxes while it's in the account, and there's no taxes when I take the money out of the account. And then there's personal money. Personal money means that it's not in an IRA or any kind of sheltered account. But that also means that whatever it earns in any given year is taxable in that year, whether I use it for spending or don't use it for spending. And looking at how to take an income stream in retirement, determining whether or not we take it from an IRA, a Roth IRA, or a personal account has an impact on your bottom line, obviously. The person we were talking about this morning wanted to have income over and above their Social Security of about $60,000. They had some money in IRA, Roth IRA, and personal money. 2/3 of their money was traditional IRA. Less than 20% was Roth IRA. Some was personal. But so should we be using Roth money or otherwise? And the answer it was different depending upon if we were dealing with a married couple or a single individual, because of the difference in priorities. The priority is potentially different for the married couple, where they're going to be in the bracket anyway, so we might as well take it out of the traditional IRA, save the Roth IRA for the surviving spouse, so that the surviving spouse has a better potential treatment later on when they don't have as much income, and we try to keep their expenses down a little bit. Because unfortunately what happens when one spouse dies, some Social Security goes away, so their overall income goes down, and their tax brackets get hammered. And so their expenses go up and their income goes down. That's not good. So we try to favor that Roth for that person. But a single individual doesn't have that issue. They're not saving for that spouse. They're saying, let's do what's best for me today. Mm-hmm. And so we were looking at using the Roth IRA to blend, to take some money so that we could lessen the tax bill today.
So generally, it's a tax play, I guess. But when you pull from an account that's not very favorable, you can do a couple of things. You could potentially, a couple of years after the fact, trigger an IRMAA, the IRMAA, the special Medicare tax, or it could affect, as you said before, your Social Security taxation, depending on where you are, and I guess potentially it could do something to your RMDs later on.
Well, that's one of the things we were looking at was, if we ran the traditional IRA down to zero, basically taking distributions, and lived off the Roth IRA for the next X number of years, we could run his tax bill down fairly low. But then after that, the RMDs kick in, and now we're back in, and the IRA has grown for the next couple of years. Now we're back into a situation where it's all taxable, and it's even a higher tax than what he's paying now. So instead of going low for 4 or 5 years and then high for the rest of time for the individual, we're opting to go not quite as low, but try to keep it that steady forever and not have a big bump when the required minimum distributions kick in at age 73 for this individual, although we're coming up on people getting to age 75 for required minimum distributions.
Yeah, you and me.
10 years away.
Well, I'll tell you what. 10 for you. That's a little more for me.
For the first batch.
Right. Okay, so this shows the importance, though, Rick, of not just thinking about today. You got to think about today when you're doing financial planning, but you got to look down the road. You got to know what's coming up. If I do this, here's what's going to happen 10 years from now, or 8 years from now, or for the rest of my life. And that's a big part of what people need to understand, is that it's not just what happens now, it's what happens later on. Now, I could spend more time on this, but we don't have a ton of time, obviously. We are somewhat limited here. So the idea of just taking cash flow from anywhere, you really shouldn't do that. You should go over this with an advisor who understands.
Have a plan.
Yeah, exactly. But if I take it from my IRA, what are the consequences today, and what are the consequences potentially a few years from now? Or if I take it from personal, or if I take it from Roth. So you just have to understand how these pieces of the puzzle fit together, and that's why we're talking about this. Now, on to the third one here, and you just mentioned it. So this flows very seamlessly, Rick. The third assumption that people make that may cost them is that my spouse will be fine financially. We've saved fine. Whatever's left over will be fine. But Rick, as you just mentioned, a couple of things happen, obviously, when a spouse dies. And generally, if you have a married couple, one of them is going to go first. So just about everybody experiences this. First of all, you lose a Social Security check. You potentially could lose a pension. Part
of a pension.
Yeah, depending on how you set it up. But, your filing status changes, tax brackets shrink. I mean, Irma, talk, if you would, please, about what happens when a spouse dies. I know we've covered this before and maybe fairly recently, but it's a good idea to bring this up again.
Well, let's say we've got somebody in their 70s or 80s, and one of the spouses passes away. Well, the lower of the two Social Securities goes away. And so there's a reduction in income. If you're on pensions, it may be that you selected something other than a 100% joint and survivor option, and so maybe some of that pension goes away. So your income potentially goes down. But on the other side, as you said, your tax filing status changes. You go from being a married couple filing a joint tax return to a single individual. And as I mentioned earlier, a married couple in 2026 can have taxable income of $100,800 or less and stay in the 12% income tax bracket. The single individual can only have half that number. So while they may be losing some income, hopefully they're not losing half of their overall income, but their taxes are going to be more. So let's say they go from $100,000 down to $80,000. Well, what was in the 12% bracket is now almost half in the 22% bracket. So they increased their expenditures. On the other side, there are the limits for the income-related monthly adjustment amount, IRMA. The cost of Medicare Part B, C, or D is half. The threshold for a single individual is half of what it is for a married couple filing joint return when we're looking at who gets triggered, who has that IRMA tax trigger. So you could have that issue involved where you were making $180,000, $190,000 a year as a married filing joint couple, and now you're only making $150,000, so you took a pay cut, and your taxes went way up. And guess what? The gift that keeps on giving. Here comes another one 2 years from now. Your Medicare just went up by $100 or something, per month. So there's always something.
Yeah, there's that surprise. And, of course, it doesn't happen, as you said, right away. It happens a couple years later when they get your tax return, and it goes through the whole system. And they say, you made more money, so we're going to have to charge you more for that. The irony here, again, here we're talking about this, Rick, is that a survivor is paying, in some cases, more tax on less income, which, once again, sounds counterintuitive.
They're paying a higher average tax on less income. So even though they're making less income, their actual physical tax dollars going out of their pocket is higher than was when they were married. It was higher when they had more income.
So in knowing that this situation comes up in the time we have left, Rick, how do you plan for that? I mean, is there a way to avoid this, or is this an inevitable thing?
Yes and no. Depends. My favorite answer, right?
Mm-hmm.
And that's why I talked earlier about conversions. And a lot of times we do conversions for that spouse for these reasons, so that we have a pool of potentially tax-free money where we may be paying 12%, 22% now, but we're avoiding 24, 32% or inclusion in IRMA later. And so it's saving us more in the future than it's costing us today. Well, it's saving somebody more in the future than it's costing us today, because one of us isn't going to be here. That's the whole issue. We're doing this for a survivor. And I see Roth conversions done for that reason more than I see it done for individual reasons, although there are times when that works too. A lot of times I'll see people defer taking their Social Security from 65 to 70 and living off of IRA money from 65 to 70 while they're in a true 12% income tax bracket, so that when they do start taking their Social Security at age 70, they may not have that much IRA income left, and it's not affecting the taxability of that Social Security in the future. So it makes it more efficient. Even though I'm paying some taxes now, I'm going to pay a whole lot less later. It's just a matter of having a plan of action, understanding how changes here affect, the changes here to affect this part over here, and just trying to be as efficient as possible, not just in 1 year, but over basically the rest of your life, maybe the rest of your joint life, maybe even for your heirs, part of your heirs' life. I say part because they only have a 10-year payout on IRAs now, so
that has changed over the years. Yeah, but 10 years is 10 years. It's not just now. I think it really takes somebody who's done this many times, Rick, to understand the consequences of this. Seems to work now, but you're really going to kind of pay for this potentially in another 5 or 6 years or 10 years, and you have to be able to see what's going to happen.
Sometimes actions have consequences, and as long as we know what those are, we can make a decision on what action we want to take today or not take today.
I don't think I could have summed that up any better myself. I think that's wonderful. This is stuff that just to reiterate the assumptions that we were talking about. The first one was I know what tax bracket I'm in. The second was I'll just take my income from anywhere. It doesn't matter which account. And the third one is that my spouse will be fine financially. I don't really have to worry about it because nothing changes. But each one of those things is related to the other. And this all comes back to understanding, well, as Rick just said, there are certain actions may have consequences down the line, and those consequences might be good, but oftentimes they're bad, and you need to, I guess, anticipate that kind of thing. If you want to talk more about this stuff, you can with the advisors at Lucia Capital Group, Professor Rick Plum, or any of them. You work with a team, Rick. I know you
Yep.
said you were talking with somebody about the Roth conversion thing. You had a couple of other people there at Lucia working with you, and you also had what was that this morning?
A training class.
Yeah, training class
for younger advisors.
Yeah, so you're also in charge of these kinds of things. So they're all on the same page. You want to give them a call at Lucia Capital Group, 800-644-1150, 800-644-1150. Give them a call. Talk about this stuff. Talk about taxes, talk about your future. That's why we talk about managing your financial future. Visit us online as well, luciacap.com, LUCIACAP.com. Make sure you take a look at our guides that we have available, bucket strategy, Social Security. Some of the stuff's mentioned in these guides too, by the way. Estate planning, rollovers, retirement income, it's all there. Download it for free. Just type in the search bar in the upper right corner what you would like to download, and you can. It'll be the first thing that comes up. Just download it and and read it. Make sure you subscribe to this podcast. Again, Managing Your Financial Future on Apple Podcasts or Spotify. Want to make sure you don't miss any future episodes. I think we're on episode number 271. We've got years worth of this stuff. You can go back and listen all you want. We are out of time. I really appreciate this. This has been wonderful information. Hopefully we haven't been too math-oriented or confusing, but hey, Rick, sometimes that's the way it is, you know?
It's taxes. It's confusing. It's math. Don't shut off just because you hear the word math.
That's right, like we used to in school. Anyway, this has been fun. I really appreciate it. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I am your podcast host, Johnny Dean. Thanks so much for listening. We'll talk with everybody again next week.
The opinion, statements, and forecasts presented herein are general information only and are not intended to provide specific investment advice or recommendations for any individual. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.